Wall Street isn't rocket science, it's a language. Learn the money terms millionaires use and speak it fluently. Assets versus liabilities. Here's the golden rule that separates the wealthy from the broke. Assets put money in your pocket, liabilities take money out. Your house? If you're paying a mortgage, it's actually a liability until it's paid off. Your car? Definitely a liability, it loses value the second you drive it off the lot. But that rental property generating $500 monthly profit? That's an asset. Rich people buy assets first, then use the income from those assets to buy the toys. Poor people buy liabilities and wonder why they're always broke. This isn't rocket science, but somehow 90% of Americans get it backwards. Cash flow. Cash flow is literally the lifeblood of any business or personal finances. It's money coming in minus money going out each month. You can be worth millions on paper but go bankrupt if your cash flow turns negative. Just ask any lottery winner who went broke, or countless celebrities who owned mansions but couldn't pay their monthly bills. Positive cash flow means you're making more than you're spending. Negative cash flow means you're headed for trouble no matter how much stuff you own. Smart investors obsess over cash flow because it determines whether you're building wealth or just playing pretend. Equity. Equity is your ownership stake in something valuable. When you own stock in Apple, you literally own a tiny piece of that trillion-dollar company. In real estate, equity is how much your house is worth minus what you still owe on it. So, if your house is worth $300,000 and you owe $200,000, you have $100,000 in equity. Here's where it gets interesting. You can borrow against equity without selling the asset. That's how rich people buy more real estate. They use the equity in property A to buy property B. Equity grows two ways. You pay down debt, or the asset increases in value. Both make you wealthier on paper and give you more borrowing power. Debt. Debt isn't evil. It's a tool. There's good debt and bad debt, and knowing the difference will make or break your financial future. Bad debt buys things that lose value. Credit cards for vacations, car loans, designer clothes. Good debt buys assets that appreciate. Mortgages on rental properties, business loans that generate income, student loans for degrees that boost earning power. The wealthy use debt strategically to amplify their returns. They'll borrow at 4% to invest in something returning 8%, pocketing the difference. Meanwhile, most Americans use debt to buy stuff that makes them poorer. The key? Only borrow money to buy something that will make you more money. Stocks. A stock is literally a share of ownership in a company. When you buy Apple stock, you become a part owner of Apple. Inside, you get voting rights and a claim on profits. Stock prices move based on how much investors think the company is worth in the future. Tesla's stock skyrocketed not because their current profits justified it, but because investors believed electric cars would dominate. The beauty of stocks? You can own pieces of the world's most successful businesses for the price of a dinner. Warren Buffett became the world's greatest investor by simply buying great companies and holding them for decades. The catch? Prices fluctuate wildly short-term, but historically trend upward over long periods. Bonds. Bonds are IOUs. You're literally lending money to governments or corporations in exchange for regular interest payments. When you buy a U.S. Treasury bond, you're lending money to Uncle Sam. Corporate bonds mean you're lending to companies like Microsoft or Coca-Cola. Bonds are considered safer than stocks because you're guaranteed to get your money back plus interest, assuming the borrower doesn't go bankrupt. The trade-off? Lower returns than stocks over time. Think of bonds as the tortoise and stocks as the hare. During market crashes, investors flee to bonds for safety. Smart portfolios mix both. Bonds for stability, stocks for growth. Compound interest. Einstein allegedly called compound interest the most powerful force in the universe, And here's why. It's earning interest on your interest. Put $1,000 in an account, earning 10% annually. Year 1, you earn $100. Year 2, you earn 10% on $1,100, which is $110. By year 10, that original $1,000 becomes $2,594. By year 20, $6,727. The magic happens because your money makes money, and that money makes money. Start investing $200 monthly at age 25, and you'll have over $1 million by retirement. Wait until 35, and you'll barely crack $600,000. Time is your greatest asset when it comes to compound interest. Every year, you delay costs you exponentially. Inflation is why your grandparents could buy a Coke for a nickel and you pay $2.50. It's the gradual increase in prices over time, which means your dollar buys less tomorrow than it does today. The Federal Reserve targets 2% inflation annually, which sounds small until you realize it cuts your purchasing power in half every 35 years. That $100,000 salary? In 20 years of 3% inflation, it'll feel like making $55,000 today. This is why keeping cash under your mattress is a losing strategy. Smart money fights inflation by investing in assets that grow faster than prices rise, stocks, real estate, commodities. Inflation rewards debtors and punishes savers. Diversification is the only free lunch in investing, spreading your money across different assets to reduce risk without sacrificing returns. Remember when Enron employees had their entire retirement in company stock? They lost everything overnight. Or when crypto investors went all in on Bitcoin and watched 70% vanish in 2022? Diversification would have saved them. Smart investors spread money across stocks, bonds, real estate, and different countries. If tech stocks crash, maybe energy stocks rise. Markets tank, international markets might hold steady. The goal isn't to hit home runs, it's to consistently get on base. A diversified portfolio might not make you rich overnight, but it won't wipe you out either. Risk versus return. In finance, there's no such thing as high returns without high risk. Anyone promising otherwise is selling snake oil. Government bonds are ultra safe, but pay maybe 3 to 4%. Stocks are riskier, but historically return 10% annually. Cryptocurrency, sky-high risk with potential for massive gains or total loss. Your risk tolerance should match your timeline and stomach for volatility. 20-somethings can take more risk because they have decades to recover from losses. Retirees need stability because they can't afford to lose their nest egg. The key is finding your personal sweet spot, enough risk to beat inflation and build wealth, but not so much that market crashes keep you awake at night. Mutual funds. Mutual funds pool money from thousands of investors to buy a diversified portfolio managed by professionals. Think of it as hiring a financial expert to invest your money alongside everyone else's. You buy shares of the fund, and the fund uses that money to buy hundreds of stocks or bonds. The beauty? You get instant diversification and professional management for a small fee. Those fees add up over time, and most fund managers can't beat the market consistently. Actively managed funds try to outsmart the market by picking winners. But studies show 90% fail to beat simple index funds over the long term. Still, they're perfect for beginners who want diversification without doing the research. ETFs. Exchange-traded funds are like mutual funds that trade like stocks. You can buy and sell them anytime during market hours. Most ETFs track an index, like the S&P 500, which means they automatically own pieces of America's 500 largest companies. The fees are incredibly low, sometimes just 0.03% annually, compared to 1 to 2% for actively managed mutual funds. That difference might seem small, but over 30 years, high fees can cost you hundreds of thousands in returns. ETFs revolutionized investing by making diversification cheap and accessible. You can now own the entire stock market for the price of a share, which usually costs under $500. It's democratization of investing at its finest. Market cap. Market capitalization is how much the entire company is worth according to the stock market. Just multiply the stock price by the number of shares outstanding. Apple's market cap hit $3 trillion in 2022, making it more valuable than the entire economy of most countries. Companies are grouped by size: small cap under $2 billion, mid cap $2 to $10 billion, and large cap over $10 billion. Large caps like Microsoft and Amazon are stable giants that move slowly. Small caps are the scrappy startups with huge growth potential but higher risk of failure. During bull markets, small caps often outperform. During crashes, investors flee to large cap safety. Your portfolio should probably include both large caps for stability, small caps for explosive growth potential. P/E ratio. The price-to-earnings ratio tells you how much investors are willing to pay for each dollar of a company's annual profit. If a stock trades at $100 and the company earns $5 per share, the P/E is 20. That means investors are paying 20 times annual earnings for the stock. Is that expensive or cheap? It depends. Tech companies often trade at high P/E ratios because investors expect rapid growth. Mature companies like utilities have lower P/E ratios because growth is limited. A P/E of 15 is considered reasonable for most companies. Above 30 suggests investors are betting on massive future growth. Below 10 might signal a bargain or a company in trouble. It's not perfect, but P/E helps you avoid overpaying for stocks. Bull markets. A bull market is when stock prices rise for an extended period, typically 20% or more from recent lows. Bulls charge forward with their horns up, hence the name. The longest bull market in history ran from 2009 to 2020, turning $10,000 into over $50,000 if you bought the S&P 500 and held on. During bull markets, everyone thinks they're a genius investor because even terrible stock picks make money. Confidence soars, people quit their jobs to day trade, and cocktail party conversations revolve around stock tips. But here's the catch. Bull markets breed overconfidence and speculation. Smart investors use bull markets to build wealth, but stay prepared for the inevitable turn. History shows bull markets always end. The question is when, not if.